Well, thank you so much for joining us. I'm Marlin Bohling with you. And as Tim mentioned, we are joined in studio by a very special guest. We have Chris Swift right here in studio with us. Hey, good morning.
Good morning to you, Marlin.
Good to have you with us
yes.
here as we take a look at our market action here on a Monday. And let's go right to the quotes. We'll start with the corn board. Interesting, Chris, where we have the July contract 7 1/4 higher at $6.51 per bushel. You have December, though, down 1/4 cent at $5.42 1/2. This is after we had a big set of overnight sales of corn. We had 1.7 million tons of corn that was sold to China for new crop delivery and 128,000 tons of corn to Mexico. And we're only getting a 7-cent kick out of that after hard selling last week. Is that good or bad? How do you read that?
Well, I think any kind of upside movement is good, and we are still moving grains. And the way we kind of look at it is, although we're going to have a lot more ups and downs in the grain market simply because of the weather and the demand that we've got, we keep watching what the government's going to do and with the U.S. dollar. And the U.S. dollar continues to move lower. We believe the government will continue with more stimulation, continuing to weaken the dollar, and that should give underlying support to both corn and beans for quite a while.
I'm glad you brought that up. In fact, let's take a look at the dollar value. Here it is. It is about as flat as can be. June futures just down 33 thousandths of a point, so not much at 90.285. But it has been declining overall ever since it looks like first part of April or the end of March over there. Do you see more weakness ahead?
I do. I think it's going to be very difficult to relinquish the position that the Federal Reserve is in right now, and that is stimulating everything. So we saw a poor jobs unemployment report 2 weeks ago. We saw that the consumer prices were up again. We know that some of the retail sales were down last week. So I think all in all, stimulation still seems to be the more pertinent agenda than combating inflation does.
Getting a lot of press
yes.
here lately. In fact, I noted when I was driving into work this morning, again on the national news headlines, I heard them talking about corn.
Yes.
Talking about lumber, but also talking about corn. We were talking about that bridge breakdown there
in Mississippi. I'm sorry, in Memphis.
Yeah. And from what I understand, there were, at that time, when they shut it down temporarily, there were 1,000 barges backed up. And a lot of that was corn. That's the main thing moving this time of year, from what I understand. I did hear that there was some ripple effects on bases upstream, but do you think that that is all going to level out now this week?
I would imagine so. I don't think that the barge traffic is going to be hampered too awful much by this. And it seems like after Friday, they got a lot of it already broken loose.
All right, let's take a look at our soybean prices right now, and let's go to the big board. Currently on soybeans, we have the July 7 cents higher at $15.93 1/4, but November only up 1/4 cent at $14.01. So similar action to what we have in the corn with the bull spreading going on. Now in Chicago wheat, with our quotes provided by bar chart, you have July dropping 9 1/2 cents at $6.97 3/4. In Kansas City, you have the July contract down 10 1/2 at $6.47 1/4 per bushel. The Minneapolis wheat really got hammered overnight, and July down 26 3/4, Chris, at $7.14. Is this all weather related?
Every single bit of it.
Really?
I think so. A lot of those drought areas for the wheat got rain, and that's exactly what they needed. It's still going to be a short crop. There's no doubt about it, and it's highly unlikely that you'll see prices move all the way back to where they started from this time last year. But I do think you'll probably hold some elevation in these prices, and then if the rain starts to subside a little bit and we don't quite get the yields out, then wheat probably start moving back higher again with all the others.
Interesting. All right. Well, we're going to pause right here. We'll come back and we'll talk more with Chris Swift. We'll focus in on livestock right after this. We're talking with Chris Swift of Swift Trading in Nashville right now, and let's look at our livestock trade. So let's go to live cattle, and on the big board, we have the June contract 60 cents higher. We're at $115.90 per hundredweight. You have the August contract 12 cents higher. We're at $118.95 per hundredweight. So we'll classify that as, well, slight to moderate gains, maybe, Chris, on the upside here on the live cattle, led by the nearby June, by the way. Now, on the feeder cattle market, here again, you're higher across the board, led by the August and September. Now, August is up 85 cents. We're at 152 even per hundred, and that would be 37 cents from our high of the opening range. We actually got as low as 150.30 and then bounced right off of that. September up 87 at 153.55 in the early going today. On the lean hog market today, we're higher on the nearbys. June 57 cents higher at 109.30. July up 62. August up 102 right now. So a little bit of strength no matter where you look in the livestock trade, and this goes hand in hand with some higher nearby corn market activity. Interesting. So
Kind of.
what does that all mean here?
I'm not real sure. You know, last week the live cattle market had a pretty big dip, and it seems like that our packing capacity is slow. We have capacity utilization, and the labor issues are harming everyone, and it's no more apparent than in the meat packing plants there, where we just don't have quite the labor to be able to push our kill slaughter level up to a rate that would be somewhat moving through the numbers that we've got backlogged.
Mm-hmm. Yeah, there's been a lot of talk about the overall capacity to run the cattle through, and it may be kind of maxed out right now. What do you think about that?
Well, for a labor issue, I think we could probably slaughter 675,000 if we had the labor and ran a Saturday kill. I know a lot of times if they weren't able to get everything they wanted on a 5-day week, that they would come in on a Saturday, and now there seems to be some hampering back and forth of whether a plant's going to open on Saturday night, and it seems like some of them are taking a policy of going to close every other Saturday.
So on our livestock summary from Friday, we had cash cattle that brought 120 on some cleanup trade. Is that going to be an uphill battle to get that to go any higher than where we are right now?
It's tough to say because we know that boxed beef prices are extremely elevated levels, and our consumer is having to eat extremely high retail meat prices in general, whether it's pork, chicken, or beef. So I'm not real sure. I know that cattle prices right now are not reflecting the same as what beef prices are, but if we begin to increase our slaughter and allow some more cattle to come through, that would drop our beef prices down and start to lose some of that margin.
All right. Chris, great to have you back
Absolutely. Always
in
glad
the
to be
studio
back.
once again. Always a treat to have you in
Thank
person.
you.
Chris Swift of Swift Trading in Nashville with us here this morning. Janet, back to you.